Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for July 26th, 2014. The market is in bullish normal conditions. On an annual basis using weekly RSI 14, we're overbought at 71 out of 100. On a 10-day basis using 10-day NDX, we're in the high end of neutral at 63 out of 100. Price relative to the 200-day moving average is at 7.48% or yellow bullish. Slope of the 50 is white bullish. ADX is a weekly trending or neutral trending 16.4. That's pulled back from 19 last week. So the market is becoming untrending. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the threshold between risk on and risk off. And that current reading is at 0.95, so we are in the risk-off conditions, meaning that riskier assets are not favored to own right now. We take that score of 0.95, compare it to the last 5,000 trading days, find the standard deviation, and we are at a risk z-score of minus 0.64 standard deviations below the 5,000-day average. You can see the last 90 days of the indicator for the risk z. And you can see we're down here at it, making a double bottom at minus 0.6. When this reverses and turns up for an extended period, this becomes an excellent swing trade in XIV. So we're stalking the re-entry on the XIV swing trade. Using blended monthly rebalancing system, next reevaluation is due on or about 1 August. These are the holdings that we currently have. And then these are the current leaders based on that lens of the blended monthly rebalancing for each of these different populations. In ETF2, the theoretical exposure is at 80%, and the model portfolio will be at 100% exposed. These are just a quick look at the components of those different categories of blended monthly rebalancing. And you can see their 3-month, 6-month, and blended performance. Only IWM is on a cash signal in the ETF 13. And in the 32, it's Europe, small caps, commodities, and agriculture are on a cash position. And that's based on price relative to the 88-day moving average or the 4-month moving average. This is the ETF Max listing of the top 40 or 50 ETFs in the database. You see it's still dominated by India, Turkey, Brazil, China, energy sector. There's some silver miners. Or China. This is the S&P 500 looked at through the same lens, only this time adding in the sector spider that these companies are a member of. I like the ones that are green and white or green and yellow. These are ones that are relatively strong on a short-term basis and haven't begun to outperform over a 6-month period yet. So they may be earlier in their growth life cycle. So International Game Technology, Best Buy, Tenet Healthcare, Intuitive Surgical, Gannett Corporation are among those. Those that are white and green, like Halliburton and Kroger, may have already peaked since they are white on this 3-month. Nothing special, only above average, and still green on a long-term basis. This is the market health check for the last 4 months of context. The vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal red lines are price levels that used to be resistance are now acting as support. And if price were to violate support levels, this would act as a price ladder for targets on the way down. This is the 200 period moving average here with the shaded red. The dark blue shaded area in the middle is the river. That's the 30-period Bollinger Band plus or minus 1. The lighter blue shaded area is the floodplain, or the 30-period Bollinger Band plus or minus 2. The pink shaded region in the middle is the dragon. That's an accelerated river. That's a 10-period Bollinger Band plus or minus a half, and that gives us early warning about when the river might be changing direction. We have two Bollinger Band channels on here, RAF regression channels. The blue line is the 10-period, and the black line are the 30, and you can see price is right at those regression lines, so at fair value. The dots are a parabolic stop and reverse that we're experimenting with as a way to quantify our beliefs on entries. And right now we have a pullback to the edge of the river in the dragon, supported by the PSAR above the Bollinger Band mean in a bullish market. And you can see that's indicated by the slope of the 30-period regression line, which is this sine wave looking gizmo here. It reached a high of about 0.32. It has pulled back to about 0.14 and gave a little hint of getting better earlier this week, but then with the sell-off in here and then this gap down, it started to roll back. As long as it stays above this dotted line, which is the 0 line on the slope scale, then the market is still generally bullish and healthy. But you can see that the 200 is inexorably catching up to us here. I really need to see price above this 195, or I'm sorry, 199 and hold line here. That was a previous swing high. We peaked above it briefly, but didn't stay above it. We really need to see price stay above that line for the bull to continue. We have been more overbought than oversold, although we're back into around the middle of normal now on %R. And then the percent price oscillator, which is a good way to examine intermediate term trends, has the jaws open to the downside, if anything, and so that gives us early warning about pullbacks. But right now, price is above the 30-period moving average, which is the center of the Bollinger Band, above the 50 and above the 200, which are all sloping up. So still a bullish market by all measures, and this is a buy on dip opportunity here. It's not until below about 193 where I would start picking up a short side bias by default on the intraday trade. But as long as we're north of the 200, I'm looking to buy dips on pullbacks. The ETF regional report, 8 out of 10 are on a buy signal, and so that puts the theoretical model at 80-20, model at 80-20%, 80% invested, 20% cash. The S&P at 78 is stronger than the EFA, the global strength, at 76. So the U.S. is still favored over the globals. Inside the U.S., it's technology at 81, large cap 78, mid cap 76, followed by the weak small caps at 74. The two strongest sectors are emerging markets in Latin America, and the two weakest sectors, U.S. small caps and the European 350. Technology is the clear leader among the S&P spiders, followed by financials and healthcare, with weakness in utilities, staples, and industrials. In the world market model, the large caps are all above average in the U.S., with technology exceptionally so. Mid-cap value and blend above average. Everything else, all the small caps and then mid-cap growth, all below average in yellow. Asia and less Japan are above average. Strength in China, Taiwan, India, Thailand, Indonesia. In the Western Hemisphere, Latin American emerging markets are the two strongest in the world, and even Canada is above average. Brazil and Mexico continue to dominate. In the business sectors, a slight wins by the U.S. over their global counterparts, but with strength in technology leading the way, and staples and industrials lagging. ETF Top 30 gives us a different way to find that relative strength, consistency, and quality among the ETFs. But in this case, it still is finding the strength in India, Brazil, energy sector, and emerging markets like Indonesia and Philippines. Among the Dow, Microsoft is a resurgent leader. It's green and white, as are United Health and Disney, which has marched its way up out of the yellow and the red to rejoin the leaders. Caterpillar is continuing to drift back a little bit. It's white and then green. Pfizer may be an early turnaround candidate with yellow and red, but real weakness in McDonald's, United Tech, and Boeing in the red for strength and yellow on consistency. And the rest of the charts just for reference. Take a quick look at the daily report now. Oops, there we go. That's the pages we'll look at 1 through 5. No signals in the overreaction or channeling. You can see the volatility continues to increment higher. ADX declining. We have channeling signals in XLI, P, and Y, and quite a few large caps to choose from for channeling and overreaction. 5DD in United Tech and Triple Screen in Disney. 551Ws in Visa and AT&T, and a ton that test out well on the auto framer on the basis of a 2-to-1 reward to risk ratio with a 10-day high as the target and using yesterday's range as the risk. And you can just see a summary of the Dow Tactical and a large number of quality setups. This 8-to-1 and 7.7-to-1 in United Tech and McDonald's. We'll take a look at those in detail during the webinar tonight. ETF 30, XIV, and IWM both auto frame out. A handful of dojis to look at and a couple channeling signals. A lot of details of quality setups among the Dow and the ETF 30 here on the auto framer, which gives you the pricing, the key pricing data. And then in the RLFF, the regression line fractal framework, these symbols that are in the top stack, the top row, are the ones that are the most number of ATRs below their own 270 regression line. So that means United Tech has a 7.5 ATRs to gain before it gets back to its 270, whereas Cisco is 8.63 ATRs above its own regression line 270. So these are the clear relative strength leaders in this bottom stack, and that offers some opportunities for swing trade framing. And that's everything I want to cover on the executive summary of the report. We'll take a look at charts of interest later tonight during the webinar, which I'll record and then post a link in the chat room for members. So this is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.